Hello, welcome to the European Open briefing for Friday, July the 7th. I'm Rafi Bajan, currency analyst at XM.com, and we're going to be having a look at what's happening in the currency markets today. So the main moves in the currency markets this morning are mostly being driven by government bond yields, which yesterday we saw German bond yields jump higher after the ECB's meeting minutes, which pointed to what we pretty much were kind of what the markets rather have been speculating for some time, that they are gradually beginning discussions on removing monetary accommodation in the Eurozone. The rise in German bond yields also helped US Treasury yields and as well as Japanese government bond yields to move higher as well. The dollar is a little bit firmer this morning. Dollar's gains are being capped by cautiousness ahead of the non-farm payrolls report due later today, while the yen is actually down, fell both yesterday and down this morning as well after the Bank of Japan intervened in the markets to push down the yields of Japanese government bonds. The euro, though, is the biggest gainer. It jumped back above the $1.14 level, and in commodities, oil is rather volatile once again after following yesterday's inventories report from the US Energy Department. But let's begin first with the dollar-yen pair. We can see that the dollar had been moving high yesterday until the first batch of US data, which included the ADP employment report and the weekly jobless claims, which were both disappointing. The ADP national employment report, which surveys the job increases in the private sector, it came in at 158,000 versus expectations of 185,000. That potentially points to perhaps a soft non-farm payrolls report that's due out later in the US session. Weekly jobless claims rose for the third straight week to 248,000 versus expectations of 243,000. So we saw the dollar yen falling to around the 113 level before going up again. We did see more positive data coming out later. We had the ISM non-manufacturing PMI, which beat expectations of 56.5 to rise to 57.4 in June, while the market services PMI was revised sharply higher from 53 to 54.2. But those gains were rather muted. The dollar was pretty much range bound until early this morning, where a surge in bond yields helped dollar yen rise higher. And so the main focus today, though, will be June's non-farm payrolls report, as it could potentially show the likely be another further indication of the strength of the US labor market, which is of course very important for the Fed in terms of setting monetary policy. Let's have a look at the euro now, because we can see the euro has been gaining rather well, pretty sharply actually, since those minutes of the ECB's monetary policy meeting for June were published yesterday. The minutes showed that the ECB discussed removing from their forward guidance the easing bias that they are willing to increase their bond purchases should it become necessary. They didn't want to do this just yet because inflation is still, core inflation at least, is still way below the ECB's target of 2%, and they didn't want to send the wrong signal to the markets. The ECB's governing council members urged continued caution in communication because they didn't want to raise premature expectations, and they said that they only want gradual adjustments in changing the forward guidance. But this is yet another step towards removing monetary accommodation in the Eurozone, and in July we might perhaps see another small step in terms of lessening the easing bias, and potentially in September the ECB could discuss their exit plan from their massive asset purchase program. For now, the euro is doing rather well out of all this. It hit a one-week high, $1.1427. Let's have a closer look at government bond yields. We can see the German bond yields currently at 0.56. That's the 10-year yields on German government bonds. That's an 18-month high. US yields also sharply higher. Since late yesterday, they hit an 8-week high of 2.391%, while Japanese government bond yields have been rallying this morning. They reached a 5-month high of 0.109%, but we can see Japanese government bond yields fell rather quickly after hitting that high, because the Bank of Japan stepped in to offer an unlimited amount of to purchase an unlimited amount of Japanese government bonds, because of course Bank of Japan has a yield curve target. They want to maintain the yield on long-term government bonds at around 0%. So we saw the yields dropping slightly to 0.09%, and that of course had a negative impact on the yen. Moving to gold, gold is also being weighed down by the surge in bond yields. We saw gold prices head back towards Tuesday's 8-week lows. At the moment, they're trading around $1,220. If we do see a soft non-farm payrolls report later today, that could positively impact the gold prices, because it would weaken the case for another rate hike by the Fed later this year. But for now, despite that, those big moves in bond yields, gold is actually trading within this week's range. Looking at oil prices, we did have quite a significant spike yesterday. We saw US crude jumping above $46.50 a barrel. This came after the EIA report showed a drawdown in US crude stocks of 6.3 million versus expectations of a drawdown of 2.3 million barrels. Gasoline stocks were also down by more than expected, so that boosted oil prices initially, but then we saw a quick reversal. Oil has now pretty much erased those gains. It's currently trading at around $44.75, and this comes after the more details from the EIA report, which showed US production rose by 1% to 9.34 million last week. So we did have actually a drop in US production the prior week, but that looks to be a temporary one. So that's why we're seeing oil prices being weighed down heavily this morning. It's going to be a busy day for data. On Friday, we've got UK industrial manufacturing output coming up. We already had German and French industrial production data, which were both well above expectations in May. And of course, later in the US session, we're going to have the US non-farm payrolls, which are expected to come in at 179,000 in June. We're also going to have Canadian employment data as well, and the IVPMI. And we should also not forget the Canadian dollar, because if we do see positive data out of Canada today, it would increase the odds of a July rate hike by the Bank of Canada even more. Of course, the Bank of Canada is due to meet next week, and also worth mentioning that we do have the G20 meeting summit underway at the moment. That's it from me. Thank you very much for watching, and have a great day.